So that's pure discount bonds. Coupon bonds work the same way, really. Now you've got intermediate payments. And so we apply the standard NPV calculations, use the exchange rates across the different dates. The wisdom of crowds will give you the exchange rates, and you add them all up. That's the value of the bond. There's one complexity here that I want to emphasize, which is how we quote the prices of these bonds. Because different bonds have different coupons, you can come up with any coupon you like. You can have a coupon that's 1% of the face value. You can have a very yield-rich bond that pays a 15% coupon. Now that sounds like a really great deal, doesn't it? Wow, you're getting paid as a bond holder, you're getting paid 15% of the face value every year. What a wonderful deal. It's this high yield bond. That's a great thing, right? Who cares? It doesn't matter. The yield only matters if there's default risk and you want to get paid more now rather than later. But if it's a default-free bond, you can specify however much you want to get paid now or later. It's just a matter of discounting it at the appropriate interest rate and pricing the bond. Bonds that tend to have higher yield are going to have higher prices. Lower yield bonds will have lower prices, but the price will reflect the value of the cash flows in a fair market. Anyway, getting back to this idea of yield, we often like to quote the bond price not in terms of its coupon payments and its NPV, but rather in the yield of the bond. So in other words, we calculate one number y such that it makes the cash flows equal to the current market price. And that's called the yield to maturity. You don't really need to know this right now, other than to know that it exists. But in another couple of weeks, we're going to actually use this to calculate the rates of return on certain kinds of biotech investments, namely venture capital. Venture capitalists use this calculation all the time. They give a different name for it. It's called internal rate of return. So that's why I'm covering it. But the way it came about was from pricing bonds. It's the one number that sort of summarizes the combination of coupon payments and principal value that will give you the actual current bond price. That's not how the market really works. How the market works is they use the various different exchange rates to calculate what value of coupons are at different dates and bring it back to the present. But in order to quote a value of a bond, instead of quoting the price of $978.34, sometimes people like to say, oh yeah, this is a 3.5% yield bond or an 8.5% yield bond. Okay, and now I want to talk about numbers. Let me show you what yields have been over the course of the last several decades. So this is using US Treasury yield curves now, and I'm going to look at it over various different points in time from 2008 to 2016 at September 1st on each of the dates. So this is what things looked like on September the 1st, 2008. This was actually before the financial crisis really hit. We got a bit of an appetizer in 2007 with certain companies having difficulties in the beginning of 2008. But this was before Lehman. It was before Madoff. It was before a lot of the AIG debacle. That was what the yield curve looked like in 2008. This was the yield curve in 2014. This is in 2015. And this is in 2016. So you can see that, wow, interest rates went way down after the financial crisis in the short run. In the long run, it's still upward sloping. People are still expecting the economy to recover and do better, but not nearly as well as before the financial crisis. You know, the long yield of 4.5% for the 30-year, that's not something that we've seen in a very long time. During the aftermath of the financial crisis, the blue line here, we're looking at about 3% for a 30-year bond. That's really low. And that's an expectation that business is not going to be great for a while, that we don't have to worry about inflation for a while. So where are we today? So let me now show you. So the yield curve you can actually get from the US Treasury website, and this will show you the yield curve as of the most current previous trading day. And drum roll, this is the yield curve. We're now at about, for 1 month, something like 50 basis points. And back out to 30 years, we're still at 3%. It's gone up, but not a whole lot. There's still challenges to the economy. And over time, I suspect that will change, particularly depending on what happens over the course of the next 3 months with the economy and what Janet Yellen does at the Fed. What she does will have some kind of an impact, obviously, on how people view markets and the strength of the economy and expectations going forward. But here in one little picture, you've got the wisdom of crowds to give you a sense of what's going on in the marketplace. So let me go back now and continue on. In terms of the expanse of time and borrowing rates, this is a picture that gets me most every time I look at it. This is a picture of constant maturity U.S. Treasuries from all the way back in the 1950s to last month. And it has different maturities, 1 year, 5 year, 10, 20, 30 year. You can't really tell the difference until you look really closely in the slides. But the thing that I want you to focus on is the fact that we are here right now. What that means is that borrowing rates are the lowest they've been virtually in all of recorded history. What this means is that there is a lot of money out there looking for a home, looking for higher yielding assets in the fixed income markets. Huge pools of capital. That's what this means. Very different from, say, the 1980s. When I was an assistant professor at the Wharton School, I remember thinking about buying a condo in Philadelphia. And I thought about it, and after about a half an hour, I decided to stop thinking about it, because you know what the 30-year fixed rate mortgage was back then? 18.5%. Yeah, I was right here. Not a good time to be thinking about a mortgage for somebody just starting out. I don't know what the 30-year fixed rate mortgage is today, but maybe it's a third of that or less, 5%, 4%, something like that. So we're in a very different world today. And that's why I'm so keen to tell you more about the fixed income markets. It's because it's a cheap source of capital. Now, it's not for everything and every purpose, because this is riskless borrowing, all right? So clearly, the US government can borrow at these rates. You and I cannot. But it does indicate that there's a tremendous appetite for safer investments. And so the question is, can we construct something safer? Can we provide a level of transparency to our investors that will allow us to sell something that's worth $285 for more than $81?